Hello everyone, welcome to another video. Today we are going to talk about inventory fundamentals, and in this video I'm going to talk about how can we calculate the cost of the inventory for retailer and how can we calculate the cost of inventory for the manufacturing business, and we will also talk about the cost of goods sold and perpetual inventory system and periodic inventory system. So here we go. First, we will start with the inventory definition. So as per the definition, what is the inventory? Actually, inventory is the total tangible personal property, like it has physical existence, and this property is held for sale in ordinary course of business. What does mean by held for sale in ordinary course of business? For example, if you will take example of grocery store, what they do, they usually buy the inventory, okay, in their routine business with the intention to resell it. So this is what is called held for sale in the ordinary course of business. Second point, your tangible personal property, I mean to say inventory, it could be in the form of work in process also. For example, if you are a manufacturing business, maybe by the end of the year you might have certain items in your production line which are not yet completed. So those items which are currently in the work in process, which will be completed and sold in the ordinary course of the business, those are also called your inventory. Sometime the third point, inventory could also include those items which maybe we will use currently in producing goods or services for the sale. For example, you might have a raw material which you will utilize, which you will consume to manufacture the product. So those consumable items, material, or certain other consumable items, maybe those are also treated as your inventory. And don't forget, inventory we will always record as a current asset in the statement of financial position, I mean to say in the balance sheet. Why it's a current asset? Because this inventory is expected to be realized in cash, or it could be sold, or it could be consumed during the normal operating cycle of the business. So that is why it is our current assets. Okay, so now we are going to talk about for the retailer and the wholesaler. Guys, retailers or wholesaler means these are those businesses who buy the product and at less price, and of course they will sell it at the higher prices and without further modification. So those businesses are called retailers, and usually retailers are trading entity. They have inventory only in shape of finished goods because they don't modify the product. So this is what is the really important point. So if you will look at here, what's it's written here, the inventories of the retailer are trading entity, consist of goods purchased to be resold without substantial modification. But on the other hand, for the manufacturing business, the inventory might be in three shape. Those businesses who manufacture the product, so they might have inventory in shape of raw material. Okay, they might also have inventory in shape of work in process which is not yet completed by the end of accounting period, and they might also have inventory in shape of finished goods. So now we are going to talk about cost basis of inventory. I mean to say we are going to talk about initial measurement. Initial measurement mean to say at first balance sheet date, at which value we will record the inventory, or I mean to say when the first time you will record your inventory, which value we can use to record the inventory. So rule is very simple. So we will measure the inventory. Okay, initially we will measure the inventory at cost. Now the question is that what will be included in the cost. The cost of inventory includes all the cost incurred in bringing the inventories to their existing location and ready to use condition. I mean to say, in short, you will you will take all those costs as a part of the cost of the inventory which you will incur to bring the inventory to the present location and whatever the cost if you have incurred to convert the inventory into a saleable shape. Okay, so all those costs will be the part of the cost of inventory. So usually the cost of inventory, we can calculate this way. Here we have a format, simple format. For example, we are going to calculate here the cost of purchased inventory, and what will be included if you want to calculate the cost of manufactured inventory. So usually the cost of purchase, as I told you, we will accumulate all those costs which will be which we will incur to bring the inventory to the present location and into the saleable condition. So here usually, if you want to calculate the cost of purchased inventory, so it might include purchase price which you might have paid to the supplier, less trade discount. Maybe sometime, your supplier might give you discount in the list price, so that discount you will also subtract, less returns and allowances. If you have certain purchase return, you will subtract here. Then you will add here transportation in, which is also called freight in, which this is the cost which you will incur to bring the inventory to the present location. And then you will add here non-refundable taxes. Non-refundable, maybe you have paid certain custom duty or import taxes in case if you are buying the inventory outside the country. So here the word is non-refundable taxes. So the VAT, usually VAT, VAT is refundable. If you have paid any taxes which is refundable, so of course you should not record as a cost of the inventory because you will recover it. Then you will add here insurance cost if you have paid. Okay, and plus handling cost like maybe loading cost, unloading cost, or any other cost which you have incurred to bring the inventory to the present location. Okay, so that those all will be the part of the cost of net purchases. Now we are going to talk about which items will be included in the cost of manufactured inventory. So usually, this is for the manufacturing organization, how they can calculate the manufacturing cost. So what we will do, usually manufacturing cost includes the cost of material used, which I will talk about how we can calculate, plus conversion cost. I will also talk about what is the conversion cost. So let's have a look first. How can we calculate the cost of material used? You can see it is written in the final column. So if you want to calculate the cost of material used, what you will do, you will take the cost of opening raw material. First you will take the cost of opening raw material, then you will add here a cost of net purchases. Maybe if you are purchasing the raw material, so you have to include all those costs which you have incurred to bring the raw material to the present location. And most probably, so the cost of net purchases will include all these costs which you have covered here. Okay, then what you will do here, you will subtract here cost of closing raw material. Like this is the raw material which you have unused by the end of the period. So if you will take opening plus net purchases less closing raw material, this is how you can calculate the cost of material used in the production. So then what you will do, you will add here conversion cost. So what is the conversion cost? Usually these are those costs which we will incur to convert the raw material into the finished product. Okay, and usually conversion cost include cost of labor and cost of overheads, like variable or fixed overheads. Okay, like rent, maybe other expenses which you have incurred during the production process other than material and labor. So those are called overheads. Like it could include rent, cost of rent, insurance, factory plant and machinery. Okay, so these are cost, will be the part of cost of overhead. So if you will take cost of material used plus conversion cost, I mean to say cost of labor and cost of overhead, this is how you can calculate the total manufacturing cost. Here you have a really important note. Please note the storage cost, maybe the cost of a warehouse or go down where you are storing your inventory, or selling cost, maybe the cost which you will incur to sell the product, like advertisement cost, etc. Or the administration cost will not be the part of inventory cost. Now here we are just gonna to talk about and here we have a note, because sometimes this concept examiner will link with the calculation of the cost of goods sold. So here we have a note. So there is an exam note like how to calculate the cost of goods sold. uh, Here you should remember, if we talk about retailers, so how we can calculate the cost of goods sold for the retailers. Usually retailers are those trading businesses which they will buy the product, and they will resell this product without substantial modification. So usually this is how we can calculate the cost of goods sold for retailer. You will take beginning inventory, okay, plus net purchases, and I told you what will be included in the net purchases, plus freight in the cost which you have incurred to bring these inventory to the present location. So if you will take beginning inventory plus net purchases plus freight, and this will give you goods available for sale. And now you will subtract minus ending inventory which is unsold by the end of the period. So this is how you can calculate the cost of goods sold for the retailer. But if you want to in exam how the question will be tested, maybe he will give you all other information, but he will miss one information, and maybe you have to go reverse. And when we go reverse, the positive sign will become negative and negative will become positive to find out the missing value. Now we are going to talk about here how we can calculate the cost of goods sold for manufacturer. Okay, so here we go. So usually, as I told you, manufacturer might have inventory in three shape. They might have inventory in shape of raw material, in shape of work in process, or in shape of finished goods. So how we can calculate? So you can look at here. Here we go. First of all, you will take the beginning direct material inventory. For example, it is 3000. Then you will add your purchases during the period. Let's assume it is 3000. Then you will subtract ending direct material inventory. For example, it is 1000. So if you will take this information, so this will give you direct material used in production. For example, it is 5000. Okay, so now what you will do, you will add conversion cost, which will include cost of direct labor. For example, it is 5000. Then you will take manufacturing overhead cost like fixed and variable. For example, it is 4000. So this will give you total manufacturing cost, and this we have already discussed above as well. So let's assume total manufacturing cost is 14,000. Now what you will do, you will adjust your work in process. So you will add your beginning work in process inventory. For example, it is 5000, you can see here. And then you will subtract ending work in process inventory. For example, it is 4000 here, you can see here. And this will give you cost of goods manufactured, which is 15,000. Then you will adjust finished goods inventory. You will add your beginning finished goods inventory. Okay, so this, let's assume this is 6000. Then you will subtract ending finished goods inventory. Let's assume it is 11,000. So this is how you will calculate the cost of goods sold, which is 10,000. Here again, examiner might give you certain data with missing information, and maybe you have to go reverse to find out the question, to find out the requirement. So now we are going to talk about inventory accounting system. So usually we have two types of inventory accounting system. The first is called perpetual inventory system, and second is called periodic inventory system. What is the main difference between perpetual and periodic inventory system? Under perpetual inventory system, actually these are the points which you should remember. First point is here, under the perpetual inventory system, we will update inventory records after each purchase or sale, like, because it is a continuous updating system. So you have to update your inventory system after each purchase or each sale. And usually this perpetual, why we need to update after each purchase or sale? Because this perpetual system is more suitable for entities that sell expensive and heterogeneous item. Expensive means, so maybe you are dealing in the diamond, and maybe you are dealing in the other expensive inventory. Maybe if you will miss a single item, so you will be in that trouble because it will cost you much. So that is why, so perpetual inventory system is suitable for entities who deals in the expensive item. Number 3, the purchases and other items related to inventory costing are charged directly to the inventory. I mean to say, whenever you will buy any product, and if you are using perpetual inventory system, so you will not use the word purchases. So you will say debit inventory, credit cash or supplier. You will not use the word purchases. So purchases word will be replaced with the inventory word. And the fourth point, inventory and cost of goods sold are adjusted as sale occur. What does mean by this point? Actually, here when you will make any sale, you have to record two double entries. The first entry we will record the first entry we will pass to record the sales price. For example, usually the entry we pass debit cash or receivables, credit goes to the sales or revenue. Okay, and at the same time you will also record the cost of goods sold. So it means how which entry you will pass, I will show you with the example also. When you record any cost of goods sold, usually we pass this entry debit cost of goods sold, credit inventory, because you have to remove the inventory and the inventory should be shifted to the cost of goods sold. So the point is, here you will pass two entries whenever you will make any sale, one with the sale price, second with the cost of goods. So here you have an advantage. What is the advantage? Advantage of the perpetual inventory system is the amount of inventory on hand and the cost of goods sold can be determined at any time. Yes, it is true, because you are updating your inventory system, okay, continuously. So it means at any time you can calculate, you can find out the amount of cost of goods sold also. Okay, and what is the drawback, the disadvantage of the perpetual inventory system is that bookkeeping is more complex and expensive, because you have to have good software, plus you have to record each and every transaction into the system, so which will be more complex. So on the other hand, we have here a periodic inventory system. Under the periodic inventory system, you know what is the main idea here? You will not update your inventory records, okay, after each sale or purchases. Here you will calculate the inventory, okay, the value of closing inventory based on the physical count, but after specific time period. Maybe it could be the end of quarter, or it could be the end of year. Okay, so here we go. So which point, we have overall 5 points here. Now first point, inventory and cost of goods sold are updated at specific interval. Maybe it is at the end of quarter or year. That is why it's called periodic inventory system. So it means here you will update your inventory at a specific intervals. So then here, and it is always based on physical count, don't forget. Okay, so suitable, this periodic inventory system is suitable to those entities deals relatively in inexpensive or homogeneous item. Like if you are dealing with the inexpensive item, for example, if you are selling tea or coffee, so it's not expensive item and it is not suitable to update your inventory record after each purchase or sale. So that is why, so this system is suitable for inexpensive item. Then here, inventory costs are tracked during the period in a separate temporary account, which is called purchases. I mean to say, whenever you will buy any product, so here you will use the word purchases account, and this purchases account will be that temporary account which will be closed by the end of that specific period. Then here, beginning inventory balance remains unchanged until the end of the period when purchases account is closed. Yes, so inventory, beginning inventory value will not change. The point number 5, changes in inventory and cost of goods sold are recorded only at the end of the period based on physical count. You know, here when you will make any sale under the periodic inventory system, so what you will do, you will just record the sales, okay, with the sale price. Like the you will pass, usually we pass the entry debit cash or receivable, credit, sales. So but we will not record the cost of goods sold at that time. But under perpetual, I told you, you have to record the sales plus cost of goods sold together, but here just you will record the sale. So here we go, with the help of example we can understand. So you can see here we have a small question. Please, you need to understand this example. let's assume they're telling you there is an entity A, January 1, year 1 inventory consists of a 1000 unit with the cost of $5 per unit. Actually here we have opening balance of inventory, we have 1000 units with the cost of $5 per unit. The following are entity A's year 2 transactions. So on April 1 we sold 600 inventory units for 4800 in cash. So it means you have sold 600 units, but you have opening units 1000. You can see here the cursor. So it means you will sell this 600 units out of those 1000 units. On May 1 we have purchased further to 50 inventory units for $5 in cash per unit. Now in short, if you want to calculate the unsold unit, how much unsold unit you have, okay, so what you can do, you have 1000 unit at the start. Out of those 1000 units you have sold 600 units, so remaining is the 400. Again you have purchased 250 units, it means 400 plus 250 units, it will become 650 units. So how we will record this transaction? If you are using perpetual system, please focus on the entries first. I'm using the perpetual first. So because uh, on inventory sales April 1, because we sold on April 1, how many units we sold? We sold 600 and we sold it for 4800. Okay, you can look at here. As I told you, under perpetual we will pass two entries, one with the sale price and one with the cost. Okay, sale price is 4800, but the cost of item sold is $5 because it is sold from the opening units. So what you will do, we will pass these two entries. So first entry you will record debit cash 4800, credit sales 4800, and at the same time you will also record the cost of goods sold. The entry will be debit cost of goods sold with 600 units time $5, because $5 was the cost. You can look at here in the opening inventory, okay, because we sold this unit from the opening. So it will be 3000 and credit will go to inventory 3000. On May 1 we have purchased 250 inventory units for $5 in cash per unit. And as I told you, you will use here word inventory. So debit inventories, the amount how you will get 250 times $5, it is $1250, and credit will go to the cash. Now the question is that if you want to calculate the value of here a closing inventory and cost of goods sold, what we will do here, so this is how we will calculate. We will take beginning inventory, which was 1000 times $5, it is 5000, plus purchases of inventory during the period, which is 1250, it is given here, you can see here. Okay, less ending inventory. Maybe ending inventory, if you are confused how we got it, I will tell you. So you have a cost of goods sold which is 3000. Okay, how 3000? Because it is here cost of goods sold 3000. So if you want to calculate the value of ending inventory, we can use two different ways. I'm telling you the simplest way. The simplest way is, so you have cost of goods sold, you have beginning inventory, you have purchases. It means I can calculate the a value of ending inventory. What I can do, I will write on the calculator, I will type on the calculator $3000, which is cost of goods sold, minus beginning inventory, which is 5000, minus purchases, which is 1250. Automatically I will get the value of closing inventory. Otherwise, if you will go to the question, from the question you can also calculate, because here you have opening unit 1000 and you sold 600. So how much unsold? 400. So 400 times 5, it will give you 2000, plus you have here purchases of 250, it is also unsold. So it means 2000 plus this cost of this purchases, which is 1250. If you will add 2000 plus 1250, it will give you 3250 as a value of ending inventory. Now on the other hand, if you will use the periodic system, so what you will do when on the April 1, when we sold 600 inventory units for 4800 in cash, so we will record under periodic system only. We will make debit cash credit sale with $4800. We will not record any cost of goods sold here, because cost of goods sold we will find out at the end of the period as a difference. Okay, then you have on May 1 you have purchased 250 inventory units for dollar five in cash per unit. So again, here you will use the word purchases, not inventory. We will say the debit purchases, credit cash, because this purchases is a temporary account which we will close at the end of that specific period. Now here, if you want to calculate the cost of goods sold and ending inventory value, so how you will do it, so please focus here. Usually, let's have a look. Please focus with me here. So what we will do here, first we will make the credit purchases account, because purchase account we will close at the end of the period. Usually purchases is debit, so to close it we will make it credit. And the value under the purchase account was 1250. You can look at here in the entry, so you will credit the purchases account. Okay. And we will also, usually our inventory, beginning inventory is debit, so once we will transfer to the cost of goods sold, we will also credit inventory, beginning inventory with 5000. Now, closing inventory is your asset and it should be debit actually, so we will make closing inventory debit with 3250. How you got? If you remember, I told you you have total 1000 units at a cost of $5. You remember, huh? Please focus here. So but out of 1000 you have sold 400 units, if you remember. Okay, so we have remaining here, it means we have remaining here how much? 600 units. Okay. 600 units, and with the cost of $5. Okay. If you, no, sorry, here we sold it 600, not 400. We sold it 600. Okay, so here you will have a 400 remaining units with the $5 cost. So it means this will give you value of $2000, plus you also have purchased 250 unit with the rate of $5. This is also unsold, so it will give you 1250. So this is how you will get the total value of unsold inventory. Okay. Total value of unsold inventory is, it will be 3250. This is how you will get 3250. This is what they make it debit here. Okay, inventory debit with the year end inventory. We have 650 units here times $5. Okay, so and here the difference will be transferred to the cost of goods sold, or the difference will be your cost of goods sold, because your debit is 3250, credit is 5000, and credit is 1250. The difference will be the cost of goods sold. I hope everyone it is clear whatever we have studied today. So in the next video, I'm telling you in advance, I will continue with this inventory topic till the finalization, and I will talk about in the most probability in the next video what will be included in the physical count. Like we have different terms. There is a FOB shipment point, FOB destination point. We have consignment, and I will also talk about inventory estimates if you have missing data. Plus we will also talk about inventory errors, so what will go wrong if you have mistake in the inventory. I hope everything is clear. See you in the next video. If you really like my video, please don't forget to subscribe to the channel. If you have any question, you can ask me through the comment section. See you guys. Thank you so much. Bye bye.